Jimmy, we always like having you on. You feel like you bring a dose of optimism in terms of the outlook. It sounds like you're still pretty positive going into year end, despite some of the choppiness that we've seen around the economic data.
I am, and I do see the world with a glass half full attitude. But with that said, I mean, I feel like the sentiment has been so awful all year long, and when we hit market lows recently, and also in June, it seemed like there are only a few people out there, and today maybe like Tom Lee and Jeremy Siegel, Professor Siegel, are the only ones that think the world's not going to end, and that it's imminent that we're going to go into a bad recession. So when I feel the sentiment being so awful, not just with consumers and with retail investors, but also with professionals out there managing lots of money, it kind of tends to make me feel that being contrarian is a good thing. And as we've seen this morning, investors are liking the PPI number. Last week's reaction to the CPI number, I mean, it was down just a little bit, but you saw what happened. And so I think investors really need to be positioned and poised for a comeback in equities before the words of a pause come out of Powell's mouth, because by then I think stocks will be a lot higher.
So, Jimmy, obviously we always say don't make too much of one data set. Now you've got CPI and PPI both showing some cooling. The Fed will say, of course, that we want to see a little more than that. But to your point, as you try to get out ahead of the central bank, how do you look at those numbers? And to what extent do you think that maybe accelerates the timeline for a potential Fed pivot?
Yeah, I think the Fed members will continue to stick with their hawkish attitude for the time being, because we haven't seen enough data yet. But everything's been focused on CPI, and the core CPI number, 40% of that is from housing. We all know housing has gotten destroyed. Rents are coming down, but it's not in those numbers yet, quite yet, because the way that BLS gathers that data is with the rearview mirror. So, once the housing numbers get into the inflation figure that the Fed looks at and people look at, I think the inflation numbers are coming down faster than I think the data suggests at the moment. So if you look at the current and forward-looking data and projections about what's going on with inflation, I think that the Fed could pivot a little sooner than what people think. I think there's a chance now that they could go 50 instead of 75. And then after that, who knows? I mean, I think that, just a few weeks ago, I thought that the Fed could easily get above 5%. But, they're doing the best they can. And also maybe that since the midterm elections are over, maybe they get a little less political pressure on the words that come out of the members' mouths. So, by the time that the Fed ends up saying a pause and or potentially down the road lowering rates again, I think equities will be a lot better. And the bottom line is the consumer is very strong, and it's because the consumer still has a lot of cash sitting in their checking accounts from stimulus and other things. And, I think that the consumer is going to continue to keep this economy going.
Jimmy, you mentioned some of the contrarian takes that you think could work in this environment. The fact that we're talking about tech as a potential contrarian take probably tells you where the market has been over the last several months, but it sounds like you like some of the big tech names, what would traditionally be considered growth names, that have been struggling a bit. Is this all just about valuation and how far they've fallen?
It is, but it's also the quality of the companies. So we still are overweight value stocks, industrials, financials. We've been overweight energy all year long. I think our clients are happy about that. But I think now you can look at some of these technology growth names that investors, have invested into for a long time now and pushed those stocks a lot higher. Those names are down a lot more than the market in general. And so I think you look and you actively selectively choose the companies that you think will perform the best going forward. You got to remember that we still haven't had a synchronized global reopening from COVID. So now with China reversing their COVID restrictions a little bit, opening up those markets and maybe the trading partners with China a little bit more, I think demand will be there. And so it's really about how, much the Fed actually does destroy our U.S. economy by raising rates as quickly as they have and as high as they are. But I think the consumer is going to continue to keep the market or the economy resilient and growing amidst all these, higher interest rates and borrowing costs. businesses are also doing pretty well too, as you saw in some of the reports you've been discussing already this morning. So businesses are hanging in there as well. So it's all about the Fed. It's all about inflation. But I think the consumer and the economy is still doing pretty well here in the U.S. And I think you can also look forward to a global rebound as well next year.
Okay, a lot of people looking or hoping that you're right there. Wealth Consulting Group CEO Jimmy Lee, good to talk to you today. Appreciate the time.